Hey, my name is Brian Nguyen and I'm a tax advisor at CleverProfits, an online accounting firm. And today, what I want to do is teach you guys exactly how and when you need to make estimated tax payments throughout the year. Let's go ahead and get started. So, at some point in time, if you've had an online business for some time, you've probably realized that you've paid penalties and interest to the government for not paying in your estimated tax requirements. And that might leave you wondering, when was I supposed to make those payments and how much was I supposed to pay? And generally speaking, the government doesn't want you to wait to make payments because it wants your revenue today, not later. And so they're going to find ways to systematically force you to pay taxes throughout the year. Otherwise, you might incur penalties and interest down the road. And that's really what we call your estimated tax obligations. Now, what are estimated taxes? It's really just you estimating what taxes you have to pay for the income that you're generating during the year, and then actually paying those in. You don't have to file a tax return, you don't even have to file a form, you just need to make a payment. The big question though is, well, how do you know exactly how much you have to pay? And the answer isn't so simple because there are multiple methods that you can apply in determining what your estimated tax obligations are that'll lead you to the same result in terms of not having to pay any penalties and interest. So what I want to do is break down 3 of the different approaches that you can take with respect to making estimated tax payments. Now, the first one that I'm going to talk about, and probably the easiest and most likely one that you're going to follow, is the prior year safe harbor. And the prior year safe harbor is simple. Take last year's tax, divide it by 4, and pay those once a quarter. That's it. That's all you need to do. But there are some exceptions and adjustments that you might need to make depending on how much money you make. And the reason why that works is that the IRS doesn't necessarily know what you're going to make in the current year, and you might not either. But at a minimum, if you know that you're making at least as much as you did last year, if not more, and your tax liability is going to be similar, if not more, you might as well just pay in based on the prior year safe harbor because you know you already paid that before in the past, and it's the best reflection and accurate estimate that you can make at the time that you make those payments. So on April 15th, on June 15th, September 15th, and of January 15th of the following year, you can pay in 25% of your prior year tax liability into the federal and state governments. Now, how do you figure out where your prior tax liability is? Well, I'll tell you, it's really simple. You go to your Form 1040 from the previous year. You go to the line that says total taxes. That's it. That's your prior year tax liability. You take that number, you divide it by 4, and you pay it in 4 quarters. Now, some of you might be subject to an exception. And the exception is called the high income safe harbor. And that is to say, if you have $150,000 or more in adjusted gross income in the year, you are now subject to the higher income safe harbor, which means that you need to pay in not 100% of last year's tax, but 110% ratably throughout the year. So instead of taking that total tax number and dividing by 4, you now have to add an additional 10% to that figure and then divide it by 4, and that's what you need to pay in every single quarter. It's punishment for having a much higher tax liability, I know. But it's really simple. You take the total tax number, multiply that by 110%, and divide that by 4, and you pay that in regularly throughout the year, April 15th, June 15th, September 15th, and January 15th of the subsequent year. And that's going to cover your estimated tax obligations, okay? Now, in some instances, you might find that you're actually making less income and therefore would have a lower tax liability in the current year based on your projected business. We understand that businesses are volatile. Sometimes the profit isn't exactly what you expected it to be. Sometimes you're making less than what you made in the previous year. And you might project out that, well, by the end of the year, you're not going to be making as much from your business as you did last year. And that's okay because, again, businesses fluctuate in income all the time. You might have had a really good last year, but you definitely don't want to pay a tax liability this year based on what you made last year if it's going to be too high. So they give you an alternative too, which is, well, just pay in 90% of what you think your current tax is going to be. As long as you pay in 90% over 4 quarters, you're going to be covered. Now, I don't generally recommend this option 2. And the reason why I don't recommend it is because it's really hard to calculate, especially for business income. You don't actually know what you're going to make by the end of the year. Heck, you barely even know what you're going to make for this month, and it's very difficult to project that out. And so it's a lot harder to calculate what that liability is going to be, and it's not a very reliable source or method to actually compute your taxes, and that's okay. So I don't recommend option 2 unless you have a pretty good handle as to what you think your income is going to be. If you have static sources of income or recurring revenue sources that aren't going to change or fluctuate from month over to month, then maybe you can do 90% of what you think your tax liability is going to be and divide that by 4 quarters and pay that in too. It's not a very reliable source. The last method that you can use to mitigate and eliminate estimated tax penalties and interest is the annualized income approach. And this one's a little bit more unique, but probably makes more sense in the context of a business. And the reason why is because you can use your actual results for the period up before that first estimated tax payment is made and extrapolate for the entire year what you think that tax is going to be based on what you projected, and then calculate your current quarter tax obligation. Now, this is significantly more difficult than the prior 2 options. And the reason why is because you really have to do a calculation every quarter as to what you think that you're going to owe on the income that you're generating. So, for example, let's say that in the first 3 months of the year, from January 1st to March 31st, you made $90,000. Well, a reasonable person could say, well, you made $90,000 in 3 months, so that means you're probably on track to make $360,000 in entire year or 4 quarters. And from there you can then determine what you think your liability is going to be based on 4 full quarters from that 90,000 quarter, the first 3 months. And then calculate your tax based on what you think that year-end $360,000 profit's going to be, and then divide that by 4 and then pay in that tax obligation. So let's say, for example, you're projecting $360,000 by the end of the year based on $90,000 of income in the first 3 months. Well, your tax on that might be like $50,000. If you're paying $50,000 in tax, you divide that by 4, boom, you're going to pay in $12,500 in by April 15th. And then you're going to repeat that calculation. So by the time you have to make your second quarter June 15th payment, you're going to have to take a look and see what you made for the first 5 months of the year, from January 1st to May 31st, extrapolate what you think that's going to be for the entire year based on the number of months that have passed versus the number of months that have left, recalculate your tax liability, figure out what you've already paid, figure out what you owe, and calculate your estimated tax obligation. Again, this is significantly more difficult than the prior year safe harbor, and I don't recommend this method unless you have a very unreliable source of income, like from your business, and you're not expecting to make as much money as the previous year, where you can simply rely on the prior year safe harbor, which is, again, the easiest and often the safest approach. So there you have it. You have 3 different methods in determining what your estimated tax obligations are from April, June, September, and then finally January 15th of the following year. Now, that's not it though, right? Just because you've paid in what is required for estimated taxes does not mean that you have paid in the full amount by the time you actually file your tax return. Ultimately, your tax return is going to determine what your actual tax liability is, and the difference between what you owe in liability versus what you've paid in throughout quarters 1 through 4 is ultimately going to determine what your final tax return payment is going to be, which is almost always due April 15th. And that is how you determine what your actual tax liability is when you file. So keep that in mind. Even though your estimated tax obligations might be significantly lower throughout the year because you're relying on, say, a prior year safe harbor method, it does not mean that you're not going to have a very large tax bill by the end of the year if you're making significantly or substantially more income in the following period, because at that point in time, you're going to have to owe everything that you haven't actually paid in, and it could be significant. So what we advise our clients to do is make sure that they're saving enough money on every dollar of profit that they're generating in their business. Remember, if you watched our last video, then you'll know that typically speaking, your business profit is ultimately going to determine what your tax liability is going to look like, because profits are a combination of revenue expenses, and expenses can be deducted against your income that's reported on your tax return. So you really want to pay close attention to the actual profit number that you're making every single month and set aside a percentage of that into a savings account so that you can pay your tax bill, whether it's throughout the year or at the end on April 15th. And that way you're not caught with your pants down, because you'll actually have money saved up regularly throughout the year that you can use to pay your tax bill, and you've mentally budgeted that amount so that you don't have to worry about paying that tax bill. And that's really key with tax planning, is not just trying to save as much in taxes as possible, which of course is important, but also managing your cash flow and making sure that, hey, I actually do have enough money to pay this tax bill by the time we get to the end of the year. And that's it. Okay. Okay? So really, with estimated taxes and tax payments, it comes down to two things. Making sure you're saving enough money and profit from your business, and secondly, making sure that you're paying the minimum required every single quarter in order to avoid penalties and interest. If you have any questions about this video in terms of how to actually calculate your estimated taxes, we do all this type of work for our clients, and you can definitely dive in. If you liked what you hear and you want to take advantage of more tax strategies, we have so many more videos on the channel that are going to be coming out explaining how we help our clients save tons of money. And you can check out the videos by hitting that like, share, subscribe button and go into the next one right here.